All right, so let's take a look at exercise 1019. Go ahead and read the details for yourself. We've got these two companies exchanging equipment and cash. So Aruza is giving up equipment worth $12,500 and cash of $3, and Lobianco is giving up equipment of $15,500. The first transaction situation we're going to look at is Part A, which has no commercial substance. If there's no commercial substance, what that means is if there is a loss, of course we're going to record all losses right away because that's what accounting conservatism would tell us to do. If there is a gain, we can only recognize a gain to the extent we receive cash. And if we receive more than 25%, we can recognize the gain. If we receive less than 25%, then we would recognize a portion of it. So let's see whether there are gains or losses and how to record them. So first, let's take a look at Aruza. What happens? So they've got equipment of 28 with a cumulative depreciation of 19. And they're giving that up at a fair value of $12,500. So what happens with Aruza? So they've got a fair value of what they give up. You can think of this as they are getting, in exchange for what they're giving up, they're getting back $12,500 of fair value. They also have to give up $3,000 of cash, and in giving up this equipment of $12,500 plus $3,000 of cash, they get equipment worth $15,500. So you can think of it as what they're getting back for the equipment is $12,500. The net book value of what they're giving up is $28,000 cost minus the $19,000 cumulative depreciation. So it's $9,000. So they have a $3,500 gain. All right, if you give up something on your books at $9 and you get in exchange something worth $12,500, then you've got a $3,500 gain. But because there is no commercial substance, Aruza will have to defer the gain. Now, how do we defer the gain? In this case, what we're going to talk about deferred gain is really we're going to do a couple of things. We're going to do one thing that has a long-term impact. We are going to reduce the cost of the asset on our balance sheet, which means we will have less future depreciation. And that less future depreciation means we're going to have higher future net income. And that's how we're deferring the gains. We're going to take this $3,500 gain and we're going to spread it out into the future by reducing the cost of our asset, therefore reducing our future depreciation and increasing our future net income. So that's how we're going to push this gain into the future. All right, remember that's the purpose of this no commercial substance rule in accounting principles, which basically says if you're making an exchange that doesn't really have any real business purpose, we're not going to let you record a gain and engage in sort of bookkeeping shenanigans to create gains that aren't really real in substance. So, how are we going to figure out how to record the cost of the asset? There are sort of two different ways we can think about recording the cost of the asset. We can think of it as the fair value of what we receive, which is normally how we would record the cost of the asset, less the gain we defer. So in this case, we're getting a $15,500 asset, which would normally be the cost of it, but we're going to defer $3,500 worth of gain, and so we're going to record it at $12,000. That's one way to think of it. Another way to think of it is the gain we're deferring is really going to make our asset recorded essentially at the book value of what we gave up. In other words, we're not going to let the book value change from our old book value to a new book value. We're going to try to keep the book value constant. So we can think about the book value of what we gave up. Which is, $9,000 plus the cash given up. $3,000, and that gets us to our $12,000. So these are the same number. And either way, there are two different ways to think about how we're going to get to the new cost of the asset. Again, we want to make sure that there's no benefit recorded in our accounting statements for a transaction that didn't give us any real business benefit. So that's why we're doing this. So we know our new cost of our equipment is going to be $12,000. So that's going to be a debit. We know we got to take the old equipment off the books. We got to take the accumulated depreciation of 19 and the equipment of 28, and we're also paying cash of $3,000. And because this new equipment number is too low, again, normally we'd record it to 15.5, but it's too low because the gain we've deferred. This $12,000 becomes the new deferred gain cost of the asset, and that's going to be the amount that we depreciate in the future. All right, so that is Aruza. What about Lo Bianco? They have an asset that they're giving up at a fair value of $15.5. And again, another way to think about this is, what do I get in exchange? I get an asset with a fair value of 12 plus cash of 3, so I get 15.5. What's my net book value? A $28,000 cost minus the $10,000 accumulated depreciation. So my book value is $18,000. And so if I'm getting $15.5 in value and giving up 18, then I have a $2,500 loss. And again, remember, accounting conservatism says we record our losses right away. We don't defer them. So we're going to record our $2,500 loss right away for Lo Bianco. So, and this is where, even though we're receiving cash, we're the one recording the loss. So we're receiving cash of $3,000. We're going to debit that. We are going to record our new equipment at its fair value of $12,500. We're going to take off our old accumulated depreciation of $10,000. We are going to record our loss on disposal of $2,500, and we're going to take our old equipment off the books, the cost of $28,000. All right, so here is our journal entry for Aruza, and here is our journal entry for Lo Bianco. So this is part A, how to record a transaction with no commercial substance. Aruza is deferring its gain, and Lo Bianco is recording its loss right away. Now, let's look at part B. In part B, it's the same transaction, except we are told to assume that there is commercial substance. The commercial substance does not change the recording, or does not change the calculation of a gain or loss, but it does change how it's recorded. In this case, Lo Bianco still have its loss, and accounting conservatism tells us to record our losses right away, so that won't change Lo Bianco. But Aruza, in this case, has a gain And because the transaction has commercial substance, in other words, we're saying this is a normal business transaction like any other, we are going to go ahead and recognize the gain. So again, if we look back at what we saw before, we know that Aruza has a gain of $3,500. So this journal entry will be fairly straightforward. If there's commercial substance, you basically just record everything as a normal transaction. So the equipment that we receive it at our cost of $15,500, and again, this is using our normal principle of what's the fair value of what we gave up. We gave up $3,000 of cash plus $12,500 of equipment. So that goes on our books at $15,500. We have to take off our old accumulated depreciation of $19,000. We take off our old equipment of $28,000. We're giving up cash of $3,000. And again, because there is commercial substance, we are going to go ahead and record our gain on disposal, which again we would do if we just sold it for cash or anything else. So Aruza has a different journal entry than they did before because commercial substance allows them to recognize the gain. Lobianco is going to have the same journal entry because they recognize their loss anyway. So you might want to go ahead and copy Lobianco's same journal entry here in Part B. They get the cash of $3,000. Their new equipment goes on at $12,500. Old equipment accumulated depreciation comes off at $10,000. Their loss on disposal of $2,500, and their equipment comes off at $2,800. All right, so this is how you record a transaction that has commercial substance. You record the gains and you record the losses just like normal. All right, one more scenario that we haven't talked about, and it's in our decision tree, and it's a possibility. What about the situation where you defer part of the gain and you recognize part of the gain? So this is that situation where what if there's no commercial substance and you do receive cash, but the cash is less than 25% of the fair value? All right, so that's something that we need to consider. None of the examples we have in A or B gets us there. We either have the whole gain being recognized in Part B or the whole gain being deferred as in Part A. So what happens if we're in that sort of middle situation? Remember, this is only going to happen if there's no commercial substance. If there is commercial substance, we recognize all our gains. It's also going to happen if we receive cash, but it's a small portion. Remember, if we receive cash, but it's a large portion, over 25%, then we just go ahead and recognize all of the gain. So only in this scenario where we have a gain, we receive cash, and the cash is less than 25%, we're going to have to recognize a portion of the gain. Now, what portion of the gain do we recognize? Well, first let's confirm that our cash is less than 25%. So what's our cash? The cash we receive, if we are Lobianco, cash in this case is $3,000. The total fair value is $15,500, so that's 19.35%, which of course is less than 25%. And so Lobianco would be in this scenario where they receive cash. But in this case, they do have a loss. So what if there's a gain? So let me change one more fact pattern or one more fact in the fact pattern, and we'll make a gain happen. So let's go back to part A. But Lobianco had accumulated depreciation of $17,000. All right, so this is a new fact or a changed fact, which puts us in a situation where we have a gain and we're receiving a small portion of cash. All right, so this is not in your book, but it's an example we're going to talk about with this fact pattern. All right, so we're going to go back to part A. So in this case, all we're changing is the accounting for Lobianco, so Aruza wouldn't have any change in a no commercial substance. They would defer all the gain. But what if Lobianco also had a gain and they're receiving cash? So let's calculate our gain. What's the fair market value of what we're exchanging? In this case, the fair market value isn't changing. It's still $15,500. What's our net book value? In this case, our depreciation is a lot higher. It's $17,000. And so our net book value is going to be 11. And so we have a gain on disposal of $4,500. Again, in this fact pattern, the net book value was 11, and we got assets worth $12,500 plus $3,000 of cash, so we got $15,500 for it. So we got a gain of $4,500. But since this is a no commercial substance transaction, and since the cash we received is a small portion, less than 25%, we have to defer some portion of the gain and recognize some portion of the gain. So what are we going to do? In this case, we're going to take this same percentage of cash, and that same percentage of cash to total fair value is the amount of gain that we are going to recognize. So in other words, you can kind of see what's going on here. You can say, well, to the extent that this transaction has any real value, any real business purpose, getting cash, we're going to go ahead and record that as gain, and we're going to defer the rest of the gain. So we take our 19.35%, and we're going to multiply that by our $4,500 gain, and that means we can recognize $871 of gain, and we're going to defer the balance, which is $3,629. So it's going to go the same way that it did before, in that the deferred gain is going to reduce the cost of the asset. Which is going to reduce future depreciation and increase future net income. So that's how we're going to do this. So let's go ahead and record this transaction with a partial deferred gain. Lobianco receives cash of $3,000. They also receive equipment. Now, previously the equipment had been recorded at $12,500, but in this case, we're going to defer gain of $3,629, and so our equipment's going to be recorded at $8,871. We're also going to add accumulated depreciation, we're going to reduce our old accumulated depreciation of $17,000. We're going to take our old equipment off the books at $28,000, and the portion of the gain we're going to recognize is the $871. All right, so what this entry shows is, in this situation where there's no commercial substance, so we can't record it like a regular plain old transaction, we have received some cash, but it's a small portion. We're going to recognize that portion of the gain. So we're going to recognize 19% of our gain right here. We're going to defer the rest of it by reducing our equipment cost and therefore reducing our future depreciation. And all the rest of the journal entry is our straightforward normal journal entry stuff. So this is our extension to the problem to show you a demonstration of partial deferral of gain. So that's all exercise 1019 in 2 parts plus an extension. Please let me know if you have any questions. Thanks.